Yo, what's going on, everyone? Welcome to another video in phase B or phase A. I'm not even sure at this point. I'm moving so quick, but this video is going to be on institutional market structure, the basics of institutional trading. You need to understand the basics of market structure. Not even institutional market structure, just understanding the basics of market structure itself. So as we know in the market, this is a big ass market. It moves a lot. We all know how quickly these price action, the prices move. One day it's at 1.00, the next is at 20.00. It's crazy. But as we know, Forex is the biggest and fastest moving market in the world, correct? I'm not sure about fastest, but it is one of the biggest markets in the world. And we know how quickly it moves. Now, in one of the way it moves, there's two different types of concepts. There's bullish and then there's bearish. Now, in a bullish market structure, the market tends to create higher highs and higher lows. So we have a low, then we have a high, then we have a higher low, higher high, higher low, and then once again followed by another higher high. Now, for bearish, we're followed by a high, and then a low, and then a lower high, and then a lower low, and then a lower high, lower low, lower high, lower low, lower high, lower low. Now, what's interesting about these lower lows, lower highs, is that every single time the market creates a higher low and then a higher high, it's breaking past the previous high, and this is called the continuation of structure. When the market is continuing its bullish momentum towards the upside, we broke a previous high once and then we broke it once again. So overall, we're basically repeating this pattern where the market is breaking a new high and then creating a new high, breaking a new high and then creating a new high. And one thing that we can notice is that every time we do create a new high, we're also creating a low that's higher than the previous low. That's why the name is higher high and higher low. So we have a low right over here, and then we have a high. Now, from this low, we created another higher low. This low is higher than the previous low. And then we created a higher high. And then once again, we created another higher low and then a higher high. Now, same exact concept for bearish, but just the opposite. So we have the low, or we have the high here, and then we have the low. Now, after that low, we're followed by a lower high, because this high is lower than the previous high. And then once again, another lower low, and then another lower high, a lower low, lower high, lower low. Sorry, let me fix that. Lower low, and then lower high and lower low. So now we understand that there's two types of trends in the market. That market's either going to be bullish or it's going to be bearish. Now there's also another type where the market consolidates. So this is called consolidation. Let me just quickly do this 28 and consolidation. So this is when the market will consolidate, and consolidation is basically when there's no trend. Let me change that to hello. Yeah, but there's no trend, and it's simply just moving from support to resistance, meaning it's moving sideways, right? It doesn't have to be support resistance, but it's not doing much. There's no trend. You're not buys or sells. The market is basically just moving sideways and generating liquidity on both sides of the market. We'll get into that later on. So now we know that the market created a bullish structure, either consolidates or it creates bearish structure. Other than these three market structures, there's nothing else. There's no like freaking ICT bullshit, kill zone, whatever. I'm sorry if anyone got offended by that, but like ICT, all these traders, they like to confuse market structure, and I don't like that. So it's really simple. There's just bullish, consolidation, or bearish. Now we understand the concept of higher highs, higher lows, lower highs, but let's try to understand true higher lows and true lower highs. So there's something called true lower highs and higher lows. So sometimes you'll see something like this where the market creates a low and then we create a high, and then we create this move down, but we don't follow it up with another move up, breaking the previous highs. So if the market does do this, it creates a next low that's higher than the previous low, but it isn't followed by another move up like this, but it did something like this. This is no longer your higher low. This is not your higher low. This is a trading range, and we'll get into this right here. So if the market does do this, we have a low and then we have a high, and then the market makes another low, but it doesn't follow up with another high. We're basically in a trading range of the low, which is the range bottom, and the high, which is the range top. The low of where the market created that low to high. We're in a trading range top and bottom until the market breaks above the trading range top. This is not your lower high, or sorry, this is not your higher low. And if the market were to break below our trading range, then at that point we would consider to be bearish. We'd be considering ourselves to be in a bearish market structure. But if we followed up with a continuation of this move up, then we would potentially say, okay, we're bullish now, and this is my true higher low. So let me go back to this. So the market is considered to be in a trading range until price action breaks the previous high, indicating a newer high was printed. So right here, we see that price creates a low to a high, but we didn't break the next high. We just consolidated. So in reality, all we're in is a trading range right here of this low up to this high, right? We're in a trading range of the low to the high. And if the market didn't print a new high, this isn't your higher low anymore. The only time we can consider to write down a higher low is if the market did this, you know, it consolidated and then boom. At this point, we would say, okay, this is my higher low. Why? Because this is that last higher low that was printed before that major impulsive move up that broke structure. So if you do see something like this, do not consider this as your higher low. Rather, you're in a trading range. Now, a true higher low is going to look like this, where the market created a low and then a high. And then once again, a higher low and a higher high. Now, right over here, we have this area where the market pushes down, creates a low higher than the previous low, but it doesn't follow it up with another continuation up. Rather, it sells off, and then we have that continuation up. So this is not your higher low. This is your true higher low. For your higher lows and higher or lower highs, what you want to do is label out that last low that was printed before the major move up. And as long as the lows are indicating higher lows, for example, we have a higher low, so we have a low, and then this low is higher than the previous low, and then this low is higher than the previous low, then it makes sense, right? But don't do something like this. This is completely wrong. And now we can easily do a bearish example as well. Let's just go to inverted. Okay, so I'm gonna have to change this really quickly, but yeah, if the market does create a high and then a low, and you see something like this happen where the market pushes up but it doesn't follow up with a new low, this is not your lower high. My bad. This is not your lower high right here. You're in a trading range from the top to the bottom. We're expecting price to break below it, but until it breaks below it, then it'll be our lower high. But until it does that, it's not considered to be our lower high. And vice versa, right here we have a high, we have our low, and then we have a lower high. Sorry, we have a lower high, right? Let me just change this. Boom. So we have a lower high, and then we have a lower low, right? Lower low. So I'm on my new laptop. It's really hard to type on this. So then we have our lower low. Now from here you might say, okay, is this my new lower high? No, because this one didn't follow it up with a continuation down. This one did. The market pushed up and then it pushed down, right? And if you look at the highs, we have a high, then we have a lower high, once again another lower high, and then boom. If the market did something like this where it broke above it, then this wouldn't even be a lower high anymore. This would be a higher high, and that's a break of structure, and we're going to get into that. So let me go back to inverted spiral normal range. So let me just delete this, delete that, boom, 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 and boom. Now let's look at breaks of structure, right? Let's look at breaks of structure. Let me just quickly write this down. Breaks of structure. So I'll make this 40 and then background on and boom. So basically, like we said, we have a bullish trend in the market, and then we also have a bearish trend in the market, right? I'll show you guys examples for both. Now, in a bullish market structure, obviously we're expecting higher highs and higher lows. We're expecting the next higher low to continue with a higher high. But if the market does something like this, where we push down, right, we break past a previous higher low, then that is considered as a break of structure, right? And this is where we can use our tool BOS down, because it's going down. So this is a break of structure because we're breaking past a previous higher high, higher low trend, and now we're creating new bearish structure. So we can say that because the market and the candles itself closed below, remember the candles need to close below the wick of the last higher low in order for it to be a bearish structure or a break of structure, and the candles itself need to close below. I'll show you guys a live example. So we have this higher low that was printed, and then once again a higher high, and then the market breaks structure of the previous higher low and then continues its bearish structure towards the downside. Now most of the times you won't always see something like this happen. Rather, you'll see a break of structure and then you'll see a continuation back up, something like that, and we'll get into how to avoid those type of traps. But yeah, that's basically what a break of structure is for a bullish example. Now a bearish example is the opposite. We have lower lows, lower highs. As we can see, we're creating a nice bearish 1, 2, 3 structure. boom, boom, boom. Now what we're expecting now is a continuation towards the downside, but instead the market does something like this, where we continue up. We have this major impulsive move up that broke past a previous higher low. Now if you go, okay, never mind, I can't go to the line chart, but on the line chart it's really clean. I'll show you guys later on. But boom, right over here we have that major break of structure of the high of the previous lower high. The candles itself closed above. Why is this a break of structure? Well, because the candles broke bearish structure, so that's why the name is called a break of structure. So now we understand the breaks of structure on higher highs, higher lows in a bearish trend and bullish trend. Now we'll get into consolidation and stuff, but let me get into micro versus macro structure now. So macro structure is really simple. This is when you're sticking towards the higher time frame, such as the 4-hour time frame, the daily time frame, weekly even sometimes, and the 1 hour here and there. Now with macro structure, what you're doing is you're finding out your significant swing point highs and your swing point lows. So you're looking for the major moves in the market where the market created a low to the high. So for example, if I was looking at structure, I'd be like, okay, this is my low, this is my high, this is my low, this is my high. But because I'm trying to stick to the higher time frames, what I'm going to do is I'm simply going to focus on the major higher highs and higher lows. So for example, we have a major higher high, higher low, major high high, higher low, major higher high, higher low, right? So we marked up our significant low and then our significant high. This significant high gave us a really nice deep retracement back down, and it ended up closing above our previous low, which indicates that this is our higher low. Now once again, after that higher low was printed, market structure reverses and goes up and continues to break, or continues the continuation of structure, right? Like I said, COS is when the market is continuing to break previous continuing to break previous highs. That's going with the trend. So then we created another high. Now after that high was printed, where is our next higher low? Our next higher low is right over here. So technically, if we wanted to consider ourselves to be in a bearish structure, we would have to break this trading range. Here to here, we're in a trading range, just like I showed you guys. That last higher low to the higher high. Now from here, the market pushes back down and creates once again another higher low that's higher than the previous higher low and continues to go up. And then once again, it comes up to here, has a significant move back down, and then significant move back up. So notice how I'm not really focusing on every single little bit of market structure here. Rather, I'm focusing on the bigger picture. And the reason we're focusing on the bigger picture is simply because the banks and institutions and all these commercial banks and these smart money traders, they're not trading the smaller time frame, right? I'll make sure I'm just recording. But yeah, they're not trading these smaller 15-minute, 5-minute, 1 hour time frames. They're trading the big ass time frames like the daily, the monthly, the weekly. And that's because they have the money to do that. And we don't have that type of money to trade with. That's why we're trying to replicate that by using their theology and concepts on the smaller time frame. So this is what macro structure is when you're focusing on the macro highs and lows, the macro swing point highs and the macro swing point lows. Now micro structure is the opposite. It's when you're labeling every single higher high, higher low, lower low, lower high. For example, we have a low right here, and then we have a high, and we have a higher low, and what do we have right here? We have a lower high, right? We have a lower high and then a higher low. Higher high. Is this our higher low? No, it isn't. This is a lower low. Lower high, lower low. Lower high, lower low. Higher high. You see how confusing it is? Microstructure is basically when you're looking at every single little bit of structure that created a higher high or a higher low or a lower low or a lower high. And this is something that I don't use in my trading, but we can implement microstructure and macrostructure from the smaller time frame to the bigger time frames to understand where the market is really going and what the structure of the overall market is. So that's a quick little example of micro versus macro structure. I don't know what just happened over here. Delete that. I'm not sure what just happened, whatever. So that's macro structure, and then this is microstructure. Now microstructure is mainly found on the smaller time frames, such as the 15-minute or the, well, technically you can find that on all the time frames, but macro is generally found on the 4-hour, the 1 hour, and the higher, while micro is usually found on the 15-minute, 5-minute, and etc. Now we went over all of that. Let's look at our case study. Let's do a quick little case study of market structure. So first off, what I want everyone to do is I want you guys to pause this video. Please pause the video and copy this, and in your mind label this. Label the lows, the highs, label what's the true lower high, what's the true lower low. And I want you guys to do a macro perspective and a micro perspective. So let's do this. I'm gonna start off with the micro perspective where we're gonna label everything. So first off, we have our low. Let me make this a 14. Boom. So now first off, we have our low. After that, we're followed by a high. Then we have a higher low. The reason this is my higher low is because price action itself closed closed above our previous low, and it was followed up by a higher high. Now, is this our higher low? No, it isn't. This is a lower low. So yeah, so basically now we're in a trading range, right? We're in a trading range where the market is just trading. So mark up your trading range from here to here. Now we have our trading range. Now the market is creating some type of bearish structure now. So now let's mark this up. The market created a low right here, a new low. Make that capital, boom, a new low, and then we have a, not sure what just happened here, my bad. New low, and then let's mark up our next lower high, right? Lower high. After that lower high, we're followed by once again another lower low, and then another lower high. Now we're followed by another lower low right here. But then the market ends up reversing and creates a higher high. So now we're no longer in a trading range. The market broke this trading range. We continued going bullish. So we had this small little time where the market was creating lower lows, lower highs, but eventually we pushed up, breaking previous structure, right? So this is technically a break of structure right here. Break of structure top, because we've broken previous bearish structure right here. We had this little 1, 2, 3 bearish structure forming, and then the market pushed up. Now we created a higher high. Now is this my higher low? No, because it didn't follow me up with a higher high. So this is now my low, right? We have a new low, and we have another lower high. Now, am I in a trading range? Yes, I am. My trading range now is from this low up to this high. Let me just delete this break of structure. So now we're in a trading. If the market breaks below it, we're bearish. If it breaks above it, we're bullish. Now we have a lower low. Now once again, we have a lower high. Sorry, we have a lower low. Sorry, my bad. I'm all over the place right now. My bad. So boom, we have a higher high, a low, lower high, lower low, and then a lower high. And then what do we have after that? A lower low. Now after that lower low was printed, we go up, and what do? We already broke past this trading range already, right? So it's no longer valid. What we did after we printed this lower low is the market pushed up and broke past this previous lower high and gave us a break of structure and made a new high. So now we have a new high right here, and we have a higher low because this higher low printed us a new high, and we have a higher high. And then we have a higher low once again, and then we have a higher high. So that's the case study on market structure. Really simple, right? It can get a little bit confusing sometimes, but if you do stick to like the higher time frames, and this was a micro perspective obviously because we marked up everything, but the macro perspective is so much easier, and we'll get into that right now. So let me just quickly delete all this. Boom, 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 boom. Yeah. Alright, so boom, now we deleted all that. Now let's look at the macro perspective. Remember, we're looking for the swing point highs and the swing point lows. My swing point low is right here. How do I know this? Well, because this is the start of the major move up. And now the way I'm going to find out where my major retracement was I'm going to find that out by seeing where the major retracement happened. What happened? When did the biggest retracement happen pips wise? This one pushed down and created a 282 pip move. This one was the biggest retracement back down with a 500 pip move. So technically I would say low to the high. This is my true high. From a macro perspective, this is my high. Now where's my next higher low? Well, clearly it would be over here, higher high. Now because we're sticking to the higher time frames, imagine this is the 1 hour. What would this look on the weekly? Well, on the weekly it'll look so clean, exactly like that, clean bullish structure. But as we make ourselves down to the smaller time frame, we're going to see small stuff like this and stuff like that. Our main job is to, with macro structure, is to differentiate from all that noise and keep it simple. So we have this low to the high. Where's our trading range? Well, from a macro perspective, our trading range is from this low up to this high. Now the market creates a higher low right here, and after that higher low, it created a higher high. Boom. You see how simple it is? 1, 2, 3, 4. That's how simple macro structure really is. You don't have to confuse yourself with all this, you know, smaller time frame 15-minute structure. Rather, you can keep it simple as possible and stick to macro structure rather than micro. But my job right now is I'm going to teach you guys how to implement micro and macro structure to find out where price is going to head next and when it's going to reverse. So let's go to the charts right now. This is GBP CHF. Now let's do a deep macro structure analysis on this. All right, let's start off with the micro structure and then we'll do macro. So on the 4-hour time frame, micro structure, we would have to go down to the 15 and the 1 hour to actually identify every single lower high and higher high that was made. But let's start off with this and we'll do macro instead of micro because it's more simple. So macro wise, this is that cleanest move up. We have this high, or we have this low, sorry, and after that low we're followed by a, make that capital, and after that low we're followed by a really clean move up that created a high. Boom, and then we have the high. Now after that high we're followed by a higher low, a macro higher low, and then the market created a macro higher high. Right, macro higher high. So we can see the structure is clearly bullish right now. Even though on the smaller time frame there's all this noise over here, right, and we see this big drop, but we know that our trading range is basically from here to here. So until we break past this low, we're still considered to be bullish. So price action makes this higher low and then creates that new higher high. Now after that new higher high was created, we created once again another higher low, and then price action creates a higher high right here. So this is a bullish macro perspective. Notice how there is a bunch of stuff happening right over here where there's this bearish structure forming, yet we can completely ignore all this noise, right? We can just basically consider this as consolidation, and we'll get into institutional market cycle later on, right? But for now we're going to focus on this. So after that higher high was printed, then we have that major drop down. Now this higher low created a higher high, and now the candles itself closed below the higher low. So like I said, for a break of structure to be valid, it needs to close below the wick of the higher low. In this case, that's what happened. The candles closed below the higher low, and that's considered to be a break of structure. And then from here we started creating clean bearish structure. So then we have a low right here, and then we have a, do we have a lower high? Yes we do. LH, make that back to an L. L right here, boom. So we have that low and then we have that lower high. Now after that lower high, are we followed with another lower low? Yes we are. My bad. Yes we are, right over here, LL. Now we created that lower low because the candles itself closed below the previous lows. Now basically we're in a trading range in a macro perspective. We have a trading range of right here and right here. If the market were to break above this previous lower high, we would consider price action to continue bullish, right? To continue itself up. Now that doesn't mean it's going to continue bullish forever. All it means is that price action is going to continue up to somewhere. Now we're going to get into how we know where price is going to go and why price is going to go to where, but for now we're sticking to macro versus micro structure. Now let's analyze this from a micro perspective, right? From a micro perspective, we have this lower high and then we have a lower low right here. Now from that lower low, we have another lower high right here, and then we're followed by another lower low right here, another lower high right here, and then boom, another lower low. Lower high, my bad, lower high, and then boom, lower low. So we can see this micro structure is still moving bearish, but right over here, we've seen that price action broke past micro structure now. So right here we can see that price broke past a previous micro structure high, a micro structure lower high, right? So let me simplify this. We have a low, lower high, low, lower high, low, lower high, lower low, right? So price broke past it. We can see that clean bearish structure. If that's confusing, let me go to my next tool and I'll make this even easier to understand. Parallel channel. Boom, look at this bearish structure, it's clean. Right over here, if I highlight this move, right over here, we can see price action is breaking past that previous bearish structure. We broke past that previous bearish structure and now we're creating micro higher highs. So now we created that lower low right here, but what did we create after that lower low? We created a higher high. Then did we create a higher low after that? Now currently we have not created a higher low. In order for us to be considered, you know, this as a higher low, it needs to break above the previous higher high right over here. So that's why we're waiting right now. And now if we analyze from the macro perspective, we're bullish. We all know from macro perspective, we're easily 100% bullish, right? Let's look at this. So we have the low, high, higher low, higher high, higher low, higher high. We did break past this previous higher low for sure, but we didn't break past this higher low over here. And the fact that price action respecting this area, there is an institutional candle right here, this does tell us that the market is overall still bullish. It's just consolidating to pick up all those orders before it does go up. And the fact that we are breaking previous microstructure right over here, we have that lower low, lower high, and the market broke past it. This does tell you that there is still a lot of buyers in the market, because from a macro perspective, we're still bullish, right? And from the micro perspective, from the macro perspective, technically we're bearish. We have the high, we have the low, we have the lower high, we have the lower low. But from a micro perspective, we're considering ourselves to be bullish because we're breaking past previous micro bearish structure. So if the micro is bullish but macro is still technically bearish, that means we have to wait. In order for us to actually properly get in for tradable opportunities, we need to wait for price action to break past the trading range. And in this case, the trading range is right over here and right over here. The way I drew that is because this is that last lower high to lower low. If we break past the high, we're bullish. If we break past the low, we're going to continue ourselves to be bearish. So this is just an overall idea, and I'll show you guys some clean examples of how you can use microstructure and macrostructure in your own favor. So let's go to Euro USD and let's look at this, right? This is a trade I've taken previously. Let me delete that. That was for the spread video, but yeah. So let's go to a fresh chart on Euro USD. And boom, delete everything, clean. Go to the second daily time frame. So I'm not going to go into why we're focusing on this zone right now. That's going to be for a separate video. But let's analyze the macro versus micro structure right now. So from a macro perspective, we have a low, we have a high, we have a higher low, we have a higher high, we have a higher low, and then we have a higher high. So clearly price action is moving pretty bullish. Now, like, what did I teach you guys about the trading range? Well, the trading range is basically going to be from this low up to this high. If price breaks below this low over here, then we're considering ourselves to be bearish. If it breaks above it, we're obviously going to continue to be bullish. Now, there is something interesting about this area, and that is that there's an institutional candle right here. Now, what this identifies to us is that price action is going to use this level, or institutions sold over here and then they bought. We can notice that by the momentum. We'll get into that into a different video. But we can see that this is an institutional candle, and this is our zone of interest. Now, macro structure wise, I want everyone to write down on a piece of paper what your trend is. So let's go to anchored note. So macro equals bullish, right? So in order for us to be in a really good trade, for a really nice big cash is a huge move, macro structure and micro structure, they both need to intertwine with each other, and they both need to correlate. If macro is bullish but micro is bearish, don't take the trade. Wait for micro structure to become bullish, and then take the trade. Right now, macro is bullish, but micro clearly isn't, and we'll get down to the 15-minute time frame to see what we would do. Now, before price did come into our zone, let's go to replay mode, right over here. So macro structure, we're bullish. Micro structure, we're bearish, right? So how do we analyze this? Well, let's look at the micro structure. We have a high, we have a low, lower high, lower low, lower high, lower low. Now we see that the market is creating lower lows, lower highs on the smaller time frame. In order for us to actually become bullish, and this let me go down to the 5 minutes, sorry. But in order for us to be considered to be bullish, we need to see some structure break. We need to see some micro structure break. So like I showed you guys in the beginning of the video, we have a low, we have a high, we have a higher low, sorry, lower low, lower high. Technically this isn't your lower low, so low, high, lower low, lower high, lower low, lower high, lower low, right? So we created this lower low, lower high phase. In order for us to become bullish, what we need to see is structure break. We need to see this last lower high break right over here. This is that last lower high that created a lower low. If we see some type of bullish structure form that's breaking past previous market structure, this gives us enough confirmation to expect some bullish pressure coming from your USD. And remember, this, you have to have a zone of interest. This can't just be random. You can't just go, like, for example, randomly on the chart and be like, okay, I see a break of structure happen right over here, that means we're buys now. You have to have a zone of interest, which is defined by an institutional candle or supply or demand, whatever. But we'll get into that into a different video. So now look at this. Price created a low, lower high, lower low, sorry, created a low, lower high, lower low, lower high, right? And then lower low, higher high. You see that? The market broke past this previous lower high right here. Low, lower high, lower low. We broke past this previous lower high just over here. So this is considered to be a break of structure. Now we also have more microstructure here. We have a high, we have a low, we have a lower high, and then we have a lower low. So we broke structure over here as well. Now what's interesting is that we broke structure inside of our zone of interest. So once price came into our higher time frame demand zone or order block or institutional candle, price action started reversing microstructure from bearish to bullish. And mind you, the macro is still bullish. So all we need to wait for at this point is for micro to become bullish as well, so that way they're both together. If the smaller time frame is bearish but the higher time frame is bullish, the trade won't play out unless you're scalping. But in order for the trade to play out, you need to make sure that the macro time frame is bullish and the micro time frames are bullish. The macro time frames are the daily 4 hour, the micro are the 1 hour, 15 minute, 35 minute, etc. So now we see that bullish structure happening and forming. We see that price broke past a previous lower high. And we haven't seen that happen in a while. Price hasn't broken past any structure. We were clearly just moving lower low, lower highs. So if price is inside of your higher time frame point of interest and it's showing you this reversal, obviously this means that your zone of interest is interesting to the institutions and banks, and they're actually looking to potentially get in for opportunities. So let's see what the market ends up doing. Boom. We broke past structure here, and we broke past structure right over here. Not only that, but we also broke past structure over here, right over here. So we're breaking past a ton of structure, and this already tells you that, okay, I have to put my charger in, sorry about that, but this basically already tells you that now the institutions are switching their buys from sells to buys. As they were selling previously, now they are buying. How do I know this? Well, look at the momentum inside of this area. Not only that, but institutional market structure that we just analyzed. We had a low, we had a high, we have a lower low, lower high, lower low, lower high, lower low, right? And lower low, lower high. We have a bunch of microstructure. Overall, that is telling us we're bearish. Now price pushes up. Let me go again to my preload channel. Look at this. You see clearly price is moving down. We have a downwards order flow. Price is clearly moving down. We're breaking past previous lows. Now we break past a previous high. What does this tell you? Well, this does tell you that institutions are now looking to buy. Structure is moving up. Now, price did end up coming back towards this institutional candle right over here. I'm not going to explain, ICs quite yet. We're going to get into that in a different video because I want to keep this simply on micro versus macro structure. But, price ends up coming. Let's just play this out. Okay, let me go down to like the 1 hour time frame, make this quick. So boom, we ended up, like I said, in like the trading, the institutional trading versus retail trading, we end up creating a bunch of liquidity over here where support traders are buying. The market breaks below those lows to take out that money, uses that 5-minute institutional candle, and then from there price switches from bearish to bullish. Now what were our confirmation for this trade? Well, one, we broke structure, so now the micro is bullish as well. Now I'm going to write that down. Micro equals bullish. Boom. If macro, remember this mathematics in your head. I'm going to write this down and I want everyone to remember this. Macro equals bullish plus micro equals bearish. That equals no trade. Macro equals bullish, micro equals bullish, or plus micro equals bullish. Let's write that down, my bad. Plus micro equals bullish equals take the trade. Take the trade. So structure is basically everything. Without having proper structure, you will not, if I just took a buy because price came into my area of interest, it wouldn't work out. Risk management wise, my stop loss would be huge. One, I'd have to my stop loss all the way down here, and it just wouldn't be good for without entering a trade without confirmation. For this, microstructure was bearish, but we waited for it to become bullish, and then we took the trade. Macro was obviously bullish, right? And now look at this. Now that price came into a higher time frame area of interest, someone might say, okay, you took the trade, but how do you know price is going to continue going up now, and how do you know where it's going to go? Well, let's look at the overall analysis of what's happening. We have a low, we have a high, we have a low, we have a high, we have a high. Sorry, we have a low, lower, sorry, we have a low and then a high, and then a higher low, higher high. Higher low, what are we expecting? Higher high, correct? So that means we're expecting euro dollar to be bullish up till there, because we're expecting euro to continue its bullish structure. We want to see euro continue that bullish structure. So if we are looking for tradable opportunities and we're entering, which we did enter right over here, our stop loss would just be about, let me see this, stop loss would just be about 4 pips. And like I said in the risk management video, if you have a really small stop loss, that means that you can use a big you can use a big lot size. For example, 4 pips. Let's do the math. If I have a $1,000 account and I'm using 4 pips and I want to use a 1 lot, that's $10 per pip multiplied by 4. I can't use a 1 lot, that's way too big. What about a 0.50 though? 0.50, which is $5 per pip, multiplied by what? Multiplied by 4. That's $20. That means I could risk 2% using a 0.50. So I'm using a big lot size, but I'm still risking 1 to 2%, and that's the beauty about risk management. But boom, we've seen that macro is overall bullish. What we need to see is micro become bullish as well. Now the main key about finding if micro is bullish is finding your proper zone of interest. We found our zone of interest on the 2nd daily time frame. Price came into it. Once we saw micro slowly starting to become bullish as well, that was basically my indication in my head telling me that, okay, bet. If micro slowly become bullish and macro is also bullish, that means that there's more power and momentum for price action to actually go up and do what? Create a new high. Break past all these highs over here, all these highs over here, and break past this high. And that's why we're targeting over here, because we know that the market is going to create higher highs, higher lows in an uptrend. Look at how big these moves, after the market does create a higher low, it creates a big move back up, right? So if you're wondering on how to catch these amazing 600 pip moves, well, look at what ends up happening. If you held this, you would have been like, you know, amazing right now. That's like 1 month of rent, 2 months of rent, who knows, but that's crazy money that you just made over there. So, and we understood this because we know that the macro time frames are bullish. We know that macro wise, price has to come above here. It hasn't met its overall target, but we can already see price is most likely going to continue up. And for the people that are saying, okay, wait, there is a you know, this looks like a nice level of resistance. Remember, support and resistance doesn't work anymore. It could work depending on how you use it, but that's not how it works. We're trading by probability and in terms of what the trend is. The trend is overall up. You've seen this bullish momentum. Now we're breaking past previous microstructure on the higher time from here over here. This obviously tells you that the market has to continue being bullish. It's going to have to break past this high. So that's how we understand where the market is going to be going in the next few couple of days, weeks, or even months, right? Now if I go to my GBP JPY trade, I show this on YouTube a lot, but let's go down to the 1 hour and let's analyze this from macro versus micro perspective. Macro time frame, we're extremely bullish, and let me show you why. Go to a brand new chart and delete all this. Macro wise, I think price, yeah, right here. So we see that price is creating newer highs, right? We have a low right over here, and from this low we created a major impulsive high. After that major impulsive high, we created a macro low. After that macro low, we created another major impulsive high. So we're creating this 1, 2, 3 bullish structure where price is moving up. Now, I'm not going to get into why we're focused on this area right here. I'll get into that in a different video. But we do see this major drop, but like I said, in a macro perspective, until we break past this trading range, we're not considered to be bearish. We're only bearish if we break past this. Now, micro time frame is 100% bearish. Let's write that down. Macro equals bullish. Micro equals bearish. And what was the calculation? Macro equals bullish plus micro equals bearish. Don't take the trade. Macro equals bullish plus micro equals bullish equals take the trade. So right now we're not taking the trade, right? We're not taking the trade. We're simply waiting for price to come back down. Now, let's go down to the 4 hour time frame and we have our zone of interest, which would be right over here. And let's see what happens after what price does. So price comes near our zone of interest, creates a bunch of liquidity. We'll get into that later on. Taps us in. Now let's go down to the 15 or 5 minute if it lets me. Taps us in. Let's look at microstructure now. Microstructure wise, did we break any structure? We have a low, lower high, lower low. What we need to see is a break of structure right over here. We need to see this lower high over here that created a lower low. We need to see that level get broken. So let's see what the market does. Now the level got broken. This is your identification to tell you that, okay, microstructure is now also bullish. This is my opportunity to look for tradable entries, right? Now let's go down to the 4-hour time frame and see how price reacted off of our zone of interest. And you can see how quickly it moved bullish. And where are we targeting? Well, obviously we're targeting the next high. I know this looks really unrealistic, but I'll show you the proof. I'll link it in the video below of the before analysis of this, because I did catch this big move. But we're targeting the next high because overall structure on the macro time frame is telling us that the market wants to go continue higher. So at this point, you can see that the market just completely broke past our area of interest, or sorry, it broke past our take profit after becoming bullish on the micro time frames and macro time frames, and then the market continued itself bullish. Now this is the actual trade analysis. We'll get into Wyckoff and all that stuff later on, don't worry. But price tapped in perfectly with a nice 11 pip stop loss, and then the market just did its thing, and yeah. So this is basically microstructure versus macro.